Okay, so I think we left off, why don't you guys tell me where we left off? We went through charity, correct?
Yeah, we did.
Okay. Oh, I know where we left off, right here. We got through all of our itemized deductions. Can we just see if we can pull those off of the top of our head going down our Schedule A? So that first section of our itemized deductions was our medical expenses. And there's one really critical takeaway from that. What was the difference between the fed and the state? And how are those treated differently?
Lumped in on federal and on state, you take them down for the other functions.
Right, so on feds, they just get tacked in with everything else, you back out 10% of AGI and that's your deduction, right? But on state, they aren't phased out, or not phased out, there's no haircut on them. In other words, you pay $8,000, you get $8,000, you don't have to subtract 10%. So, but then the kind of critical thing here is, who do you push the medical expenses to, the higher or lower person on Montana? Everything other than insurance. This is our good term. Higher or lower income person? Why? Because our AGI is lower, so the 10% is lower, so the haircut's lower. But then who do you push the insurance premiums to? The higher, because of course we want to equalize as much as possible. Okay, so then that second little section going down is that after medical. I don't even know. Is it interest or taxes? Taxes, okay. So what do we know about that? What do we get? We get real estate taxes, we get personal property taxes, we get state income tax, right? I think that's about it. We learned about points, we get that. But then when you go over to the federal income tax, or sorry, the state income tax return, you don't get to deduct state income tax on the state income tax return. You deduct the federal income tax on the state income tax return, but only up to how much per person?
5,000.
$5,000. Good. Okay, then that next section is interest. We get real estate interest, we get investment interest. Is that it? Go ahead. One more time. Okay, education loan interest doesn't go on the A. Where does that go?
On the front of the 10.
Front of the 1040 deduction for AGI, so everybody gets it, right? Regardless of whether you had a good or not. Then the next section is what? Casualty and loss. And I think we spent no time on that because that's essentially going away, other than if you have a casualty loss that's attributable to a federal disaster area. And last year, in 2017, this I think this speaks just phenomenal amounts to just the ravages of climate change. For 8 years, we had one federal disaster area declared. Last year, we had 3. California wildfires, I forget the names of the hurricanes, that's pathetic. I think Harvey and Irma, there he goes. Finding out. Okay, so then after casualty and losses, we go to, I don't know, I can't really pull this off the top of my head, miscellaneous deductions?
Miscellaneous.
And there's 2 basic categories, right? You may remember what they are.
Those subject to 2% AGI and reduction and those that are not.
Yeah, those that you have to phase out with the 2%, those that you don't. All the ones that you have, that you subtract 2% on are all going away. All those items deductions are going away with TCJ. So we don't get our job search expenses, our tax prep expenses, our union dues, our, what else is in there? Subscriptions to investment journals and things like that, that all goes away. The only thing that's left is those miscellaneous deductions not subject to 2%. And we looked at a list of things that, like I said, I've never seen anybody take before other than gambling losses. So that's what we know about Schedule A. So this is the second topic in Chapter 5. which is, did we start this? I feel like we started this. Okay. Which is the whole category of education expenses. So rather than sit and talk at you, why don't you tell me what you know about a Section 529? We did start this.
Anybody can contribute to it.
Yeah, which is awesome. I set up one for my kid and I asked my brothers and sisters for Christmas, please put, instead of, plastic toys, please put $50 in the 529. Grandparents can leave big chunks of change in them. Regular folks can put, $100 a month in them. Are they tax deductible?
No.
No, so you don't get any immediate tax benefits, so why do you do it?
There's no tax on the interest that you make on it, and when you draw it out, there's no taxes.
Yeah, so it's one of those tax deferred vehicles that you put money in for the life of your child, grandkids or whatever, and then it doesn't, you don't pay taxes, it grows, and then when you pull it out, awesome, right? 2 TPs. So when you pull money out of a 529, I was in fact just working on this a couple nights ago. I had a client, he's amending something from before, so I was working on it in the middle of the year. But he paid like $14,800 for his kids' education. But he pulled money out of the 529 for part of that. And we were amending it to get him the American Opportunity Tax Credit because he hadn't taken it. So could I take that full $14,800? How come?
The 529 is not.
It's not what?
I don't know what I'm saying. Yeah.
You can't do it because you've already got a tax benefit from it. So I had to take the 14,800 minus like the $6,000 that he pulled out of this 529, and only the remaining 8,800 could I take and do the math for the AOTC. Okay, you know that. You can never double dip. If you've gotten a tax benefit, that's it. Okay, then we talked about ESAs, and I didn't spend much time on this because it's only $2,000 a year. Why would you fund that when you can do a 529? Then we have the higher education expense deduction. Is this the same thing as the student loan interest? No, it's not. It's a separate line item on deductions for AGI. And I think that we just go into that optimize in our software. There's so much circular algorithms in that, it spits it out. Every now and then somebody will get one of these. But usually the credits are obviously way more valuable than a deduction, so it usually comes out that way. Okay, I think the only other thing we have to talk about. Okay, almost. So again, I'm not going to spend a ton of time on this because it's gone away, but this has been in place for maybe, I don't know, 15 or 18 years. That high-income people start to lose their itemized deductions. So that essentially raises their highest marginal tax rate, right? And you can see, I mean, it's quite high income. I don't think I've ever had one doc who I think is phased out on his itemized deductions. But, I mean, most people don't. This is all going away, so it's a non-issue.
So we won't see these on like our.
No. I pulled out no, you won't. And we need to kind of work together on that because honestly, I didn't go back and vet all of these tax returns through TCJA in August. I was just trying to get the frickin' thing on Moodle for the first day of school. So we'll have to look at it. I know I pulled out casualty and losses from your second manual assignment, right? I told you to X that out. Oh, yay. Okay, great. Easy peasy. All right, I am going to try, for the benefit of those that aren't here, to go through our second manual assignment and look at it. Piles down here. So Shelley, I just brought your folder and put a big question mark on it.
I have the form.
Okay. I just didn't make proper notes. I couldn't remember what we did. Okay, so the first thing that I kind of want to do together, well, that's not true, is look through the combination of the instructions and the source documents. So, obviously this is a lot longer than the last one. So what we're doing, just bear with me as I kind of read this and then flip back and forth. So we're doing 2017, we're doing both Fed and Montana again. And again, this is meant to emulate what I would do if somebody comes, particularly new client where I don't have background on them, and they just come and go like, bleh, they just give you everything. And they give you way more than you need. People are like, here's my utility bills for the last year. Well, I only care about that if you've got office and home, or part of your home's a rental. And then I don't want your utility bills because you're gonna pay me $110 an hour to run a tape over them. Just give me a number, right? But you have to get clients to that point in time. And you get them there pretty quick when you quote your hourly rate. They're like, oh, I get that. So they want to just give you everything. So the first thing you have to do is take the stack of documentation and figure out what you need out of it. So what I've done is at least extricate for you like the salient documents. I've gotten rid of all the stuff I don't need. But so then what we really want to do, so which I said here, can you see this in the back? Or I guess you've got it in front of you too, is to go through all your source documents and highlight the data you think is pertinent. Okay, W-2s, dependents are right up here. Super straightforward. Make sure that you figure out what's going on with Catlin or what's her name. She's born in '98. We're doing a 2017 tax return. She earned $8,300 and attends Sugarland Community College part-time. So you need to figure out whether you think she's a dependent or whether she's her own dependent. Then here's the W-2s. Laura's an RN, Brett's a truck driver. These are the totals from his Phoenix and Houston W-2s. So they've moved. Oh, maybe you don't have to do a Montana for this one. Hold on a sec. When we get together, we'll see. No, you don't have to do it because I've got them moving in the Southwest. In other words, they were in Phoenix for like 3 months and then they moved to Texas. So then they've got, on the next paragraph, dividend and interest income. Note that the Social Security numbers on the statements, a couple of them are custodial accounts, which is, I'm not going to go too deeply. There's different ways that your kids can hold interest and dividends. And for custodial accounts, in this situation, and this is just me telling you how to handle this because we haven't really covered it, the amounts are so small, just put it with the folks' income. But if the kids have a lot of interest in dividends, there's a whole special thing they have to do where they have to file their own tax return and then pay tax at the parent's highest marginal tax rate. But we haven't really worried about that. You don't know that, just throw it in with everything else. Since the Schedule B is not required, ordinary dividends just go on the face of the 1040, you know what I mean there. And capital gain distributions go directly on the Schedule D. You know what I'm talking about there. Also, Evans received $193 Arizona state income tax refund from the prior year. They had previously deducted it. What does that mean?
It's taxable.
Why?
Because it was deducted, it was used in order to get a return, the tax money, so.
Yeah, they got a benefit from it in the prior year, right?
Yeah.
If they hadn't itemized their deductions and they got a refund, would they have to pay, would it be taxable? No. Let me say that again, because this is a good point of contention or confusion. If I itemize my deduction from the prior year and I get a benefit from that state income tax deduction, then, and I get a refund, it's taxable. If I didn't itemize and I get a refund, it's not taxable. But let me make it even a little bit more complicated, which is, say that standard deduction, say I'm single, my standard deduction, how much is it, 6,300 in the year we're in? Is 6,350, okay. Is 6,350, and say that my, I itemized, and my itemized were only 6,500, and of that 6,500, my SIT deduction was $1,000. And I get a refund of $800. Is the whole $800 taxable?
It shouldn't be.
It shouldn't be, because I didn't really get that much benefit from it, did I? Only, I would have gotten this regardless, right, the 6,350. I itemized, that threw me over the 6,350, but I really only got a $150 benefit of my SIT write-off, because I would have gotten this anyways. Okay, your software is going to kick this out. But you will wonder, like, oh my gosh, why did not the whole $800 show up as taxable income the next year? Well, you only got $150 worth of benefit of it.
So only $150.
Only $150 is going to be taxable in the subsequent year.
And do you calculate that by figuring percentage?
You don't, it's just a total dollar amount. I had a thought about that when I was just writing it up there, but no, it'll kick out the full 150. Not pertinent to this, the whole $193 is taxable. You just need to figure out where it goes.
Okay.
Okay, what's next? Okay, 2441 information. You probably have no idea, well, I know you don't have any idea what that is, because we haven't done that yet, so I'm going to give you a very quick briefing on it, because credits are next chapter. But you're going to be doing this while we're going through the next two chapters. But at any rate, when you have kids or dependents, you get a credit for their care. And it doesn't phase out. In other words, you can make $5 million a year and you still get 20% of your daycare expenses as a credit. What else can I tell you about that? Let's just leave that, and then when we get to the 2441, it's one of the last things you'll do, because you have to get all the way through your AGI and then your itemized deductions, and remember your credits come after that. So you don't really need to worry about that quite yet. But all you're going to need to do is pick up the percentage of their daycare bills that they get. And there's a table. Actually, I'll just show it right now. Come back to it. So it's in chapter, of course, you could also look at the instructions for the 2441. It is in chapter 6, and the table's on page 6-14, and you'll very easily see where it is. So on page 6-14, it'll tell you if your AGI is between X and Y, then you get 26%. And if it's between Z and A, you get another percent. So once you get your gross or your AGI figured out, then you can do your 2441. Okay, what's a 3903?
Moving expenses.
Those are your moving expenses. Laura and Brett moved this year. The move was made so that their new place of employment from their old home is 983 miles, and their old home from their old employment was 43 miles. That's just data you have to plug into the 3903 to make sure you take your expenses, right? They made the move due to the fact that Brett lost his job in Phoenix, and they felt there were more opportunities in Houston. Fortunately, he was correct. Within 1 month of moving, he found a full-time job. So here's all their expenses. I give you the address of their old home, the address of their new home, and then I say, attached, please find closing statements from both the house that was sold and the house that was purchased, and we'll look at those in a moment. These documents, along with the 1098, are used to complete certain part of the Evans Schedule A. So, first off, what's a 1098? Remember?
That's that, your mortgage, information, your interest that you paid.
It's your mortgage interest statement.
Yeah.
This is where it gets tricky because at the end of the year, you'll have clients bring you, a ton of 1098s. They bought a house and they sold the house, like, personally. They've got 3 or 4 rentals. Well, you've got to figure out what goes with what, right? So really, that requires sitting down with the client and just going, like, here's this such and such a long number at such and such a bank. What is this? Right? You can't guess at that kind of stuff. That's the first thing. You just have to get that from the client. And I told you that in the case. The second thing is, it's very convoluted because on a closing statement in the year of a purchase or sale, some of the 1098 amounts may be in the closing documents. So am I adding those numbers together? Is it already in there? That we're going to have to look at too. And that's just really honestly about experience. Here's all of his moving expenses, or their moving expenses. You got to figure out what they get. And you know this. Okay, so now we're kind of going down the Schedule A a little bit more. Other things that they think they might get, maybe deductible, and this is just, again, where they just dump all the stuff on you. You're the accountant. They defer to your knowledge to decide on each item. So they have a local income tax in Phoenix. Do you think they get that?
Yeah.
That's deductible. They license 2 cars and an RV in Arizona at $255, $275, and $122 respectively.
They get that, but isn't there supposed to be like the value of it?
Yeah, I should have given you that. Huh. Okay, let's see, did I give anything else on that? No. All right, so do you guys track what Claudia's saying? That you can't take the whole amount of the license plates, because only a percentage of it is what? Is actually taxed. So let's just say that I've already pulled that. They've given me the, what's that called, the registration, and you can see one of the whatever codes says, in Montana at least, it says COOPTX, cooperative tax or something. So let's say those are the numbers. That's the tax numbers. So you got to figure out if they get the RV in addition to the cars. They contributed $187 to their church, and then they let the church borrow the RV for 4 weekend outings, and it was valued at $125 an outing. So you need to figure out what they get of that. Here's their medical bills, and you need to figure this out. And they had some paid for dental insurance. They have contact lenses. They had ER. They had orthodontics for one of the kids. And then they had to travel 1,045 miles. I don't know, for the orthodontics. That's silly, but just put it in there. You got to figure out what the mileage is. Okay. Then they had a car loan, and they paid $655 on that, and they had a Visa and a MasterCard, and their interest on that came to $548. So you can figure out what to do with that. And then, 1098. Okay, and then there's a form 1098S. You probably haven't seen that term before. That is sales proceeds from a home. Sales proceeds from a home. Okay, we're completely just crossing out the 4684. That's due to casualty and losses. And then this is really the only part that's going to make this kind of a bear. So they owned a rental house, and it's called Section 1250 property, which doesn't mean anything to you right now, but when we go to the form where they sold their rental, it will matter. So highlight that, because that's will tell you what section of the 4797 to report this on. And you don't know what that is, but just write it down. It tells you the fact that it's Section 1250 property directs you to which part of the 4797 you report the sale of. The sale date was March 30th of the current year. So basically what they were doing is they were living in Phoenix, they sold their private home, they sold their rental, and they moved to Houston. What kind of property is a rental house? I mean, it's section 1250, but I mean, is that like going to be ordinary income, or is that going to be capital income, or what's that going to be?
I think a lot of seconds, residents.
But it's not their residence, it was always a rental.
Oh, yeah, okay. Would it be considered property?
It is property, but I'm trying to get at what if they have a gain on it, what sort of
Oh, capital.
tax would it be? It's absolutely capital, it's investment property. So then I tell you, here's their rental information. How much revenue, so they only had it for 3 months, right, January, February, March, so they didn't have much rental income. They drove some miles, and you get your mileage for your rental, so if you drive back and forth to your mileage, or to your rental. And they did, to show it to tenants and maintain it. They had some maintenance, they had some cleaning, and then I'm telling you, again, this is another thing you would have gotten from them. They would have given you the 1098 for the rental, but because you guys are new to this, I didn't want to inundate you with too many of them. So I'm just pulling the data off of it and giving it to you. But you would get a 1098. So they had some mortgage interest, some property taxes, some homeowners insurance. And then obviously you can already see they're going to be at a loss, right? So you need to think about with rentals, let's quickly do what's the rule with rental losses. By nature, they're considered to be what? Active, passive, or portfolio?
Oh, passive.
Yeah, by nature, they're passive. So you know that you don't really get passive losses. Except for there's an exception for real estate that says what? How much do you get a year? Up to,
Oh, no. 25,000.
up to 25,000. Except for if your AGI is over 100 grand, then it starts to go away 50 cents on the dollar. So I don't expect you to know all this off the top of your head. I've been doing this for 25 years. But just be aware of that, make a note, like, yourself like, oh, I better watch out for the rental loss. I don't know what their AGI is off the top of my head right now either, but I know that that's something I have to consider. Are they going to get their whole rental loss? And then lastly, the one item that I didn't put up there that you have to calculate, what do you always get on a rental property? That's another write-off.
Depreciation.
Yeah, depreciation. And up till now, you've just thrown that into the 4562 software and it spit out a number, and you have no idea if it's reasonable or not. I think I give it to you, but the number, because we're not there yet, that's our whole last chapter that we'll test on during finals week. Depreciation is a really big topic. But you're going to actually fill out the 4562. And I can just tell you right now, it's just one number. And then you take it to the total column. So you're not going to be filling out some crazy schedule. This is an old piece of rental property. So all you're going to do is take the number and dump it right into the 4562. And I'm going to give you the number. I think. Let's see. Okay. So I'm right here now. Is everybody with me? So before you can complete the schedule, obviously you have to do the 4562 to show depreciation because that's one of your expenses. So you can't get to your rental loss until you've got the depreciation number there. All right. So schedule 4797, 4562, and D. You know what a 4562 is. You know what a D is, right? And so 4797 is the only new one. And then that's the form that we use when we sell rental property and lots of other things, but I'm not going to go into that. For our purposes, we're using it because I'm selling rental property. Now, your other history of selling capital gains and losses, or selling capital assets, excuse me, were what kinds of assets? What were you selling? Okay. No, I think, like on the last one, didn't we have some capital activity? What was I selling? Stocks, right? And did those go on a 4797?
No.
No, they went on that 8949. And then traveled to the D, right? Because that's a snapshot form, captures everything. This is the same concept. Your schedule of origin is a 4797, so you got to do the calculations on that. And then you carry the results to the D. Okay? So all you're going to have on your D this time is the sale, the result, the takeaway number from the sale of the rental and your capital gain distribution. So you're going to have 2 things. And then you know where the D goes. That travels to the 1040. And then I was really sweet on the last one. You had a capital loss, so you didn't have to figure out the 2-tiered taxes. But on this one, they have a pretty hefty gain on the rental. You want me to say that again? On the last assignment, their capital activity resulted in a loss, right? So you didn't have to figure out like, oh, part of the income was taxed at a different rate. Well, a loss, right? So that was easy. This case, they're selling rental property, which is going to generate a gain. So you are going to have to figure out, oh my goodness, part of this is capital, and part of this is ordinary income. And we'll review that when we get there. But just put that back in the back. Oh, sorry. Gracious, is that me? No.
I think it's me.
Okay, okay, so let's see, where are we? All right, so they sold their rental property for $87,500. They had originally bought it for $61,100. And they have made capital improvements, including a deck and landscaping for $2,224. What do you do with those capital improvements? What do you think that does to the rental? Go ahead. It does. It brings up the adjusted basis. So the basis, i.e. the cost of the rental, is 3 things. It's the original cost, plus the capital improvements, plus whatever it cost me to advertise to sell it. So 3 things. You haven't ever studied that before, so you probably just need to get that now. They sold it for $87,500, but the gain isn't just minus $61,100 because they made capital improvements, and they also had costs of sales of $177. They took out an ad on a realtor's website, or for sale by other website. And then I tell you to include both of these items in the adjusted basis calculation for gain and loss of business property. Any property that you sell really comes back to the same calc, which is selling price, oops, where am I? All the way down here. Which is selling price minus adjusted basis. Equals gain or loss, right? And with our stocks, it was super easy. It was, in that situation, we called it proceeds minus cost, right? But with real estate, the adjusted basis calc is more complex. So, well, it might not be, but it usually is. So let's do what we think that calculation is. Adjusted basis equals, what did I just say? What are some of the things I just told you?
Original cost.
Yep, cost.
Capital improvements and advertising.
plus capital. So this is one of those things, like you hold on to a rental for 30 years, you gotta hold on to those frickin' receipts forever. I put on a new HVAC system in 1998 and a new roof in 1999. I mean, that is onerous, but that's really one of the big things. You have to keep receipts forever. You have these thick files on that.
And that always just goes directly into the adjusted basis.
Yep.
Not a percentage or anything.
Yep, nope, it goes all the way, and you can't deduct that stuff that, let's just talk about this really super quickly. What's the difference between a capital improvement and just regular old repairs and maintenance that you get to write off straight away? Because clients do not like this when I have to tell them this.
Capital is going to be making an improvement that adjusts the value of the house, where repairs and maintenance just are.
Yep. Yep, that's exactly what it is. And it's not so much adjust a value, but it extends life. I just put a $9,800 roof on my fourplex, and I bring it to my accountant, and I'm thinking like, score, I'm gonna have a huge write-off this year for my rental. And your accountant goes, sorry, and it's right in the Internal Revenue Code. Structural adjustments, re-asphalting, re-siding, re-roofing, HVAC systems, building envelope stuff, that all extends the life of your fourplex. So I can set it up and depreciate it over a long time, but I can't write it all off in this year. So let me show you where the depreciation comes in. So at any rate, yes, to answer your question, you do always have to add your capital improvements here, plus your selling costs, minus your accumulated depreciation. So all those things increase adjusted basis, but then you've gotten that tax benefit of writing it off to depreciation over years. So you have to subtract that. A lot of you turned in with the tax returns that you just did this last chapter. I can't remember who it was, but you had a depreciation schedule attached, and that shows the accumulated depreciation to date. And here's your information on that. The depreciation through the date of sale is $8,824. This $8,824 includes the 2017 depreciation of $524. So that's where I give you the number for the Schedule E. So it's a little tiny bit of depreciation because I only owned it for 3 months. But throughout the life of the rental, I've taken $8,824. So do you see what I'm saying? The AD, or the accumulated depreciation, is the number that goes in that adjusted basis count, but the little $500 number is just the current year expense. Okay. So that's all I've got to say about that. Let's take a quick look at the source documents, and then I want to just give you time to start. I'd asked you, did you get the forms printed out? Some of them. Okay. So you should know now what you need to print out. And then I haven't done this in the past, but well, I guess I'll kind of turn it to you for a second to see if you can figure out what order do you think you need to do these in. Based on what we've just gone through, what, you know, where are you starting with all this? And if they might not be the same for everybody, but I mean, what kinds of stuff do you have to do first?
Well, I would think Schedule D.
Okay, so you have to do a D, but can you do a D? Can you go straight to the D and take that, care of that?
Well, we start.
No. You have to do the 4797 first before you can get to a D, right? And what was the other thing that went on the D then?
4562.
No, I think the 4562 goes on the D. There was one other thing that was capital that I told you about.
The distributions.
Yeah, those capital gain distributions. And those come from the brokerage statements. And you know how to read those because we practiced that last time. Okay, so that's one thing. I mean, and you might not all do it in the same order, but like, yeah, that's the complicated part. I probably knocked that off first. Okay, then what have you already done that should be fairly easy but at least redundant, that you know that you have to do? What's another source of income for them? So one of the sources of income is the sale of the rental.
The rental income.
Yeah, the Schedule E, right? Gotta do the Schedule E. And while you're doing that, you're gonna have to fill out just that one number on the 4562, right? So that kind of comes as a package deal. There's one other backup form that you need to do to go to the front of the 1040,
The moving expenses?
the 3903, yeah. And really, everything else on the front of the 1040 is a direct enter. The wages, the interest, the dividends, right? Because you don't have enough to do a Schedule B. Wages go right on the face. Honestly, when you break this down, it is not that crazy tough. Then on the back page, you've got two things you need to calculate before you can get to the 1040. What's one of them?
You need to figure out whether the oldest child is a dependent
Okay, right, you have three things to figure out, thank you. One of them is, do I get to take the oldest daughter, or son, whatever, daughter, I think. What else do you have to figure out on the flip side?
The child tax credit.
Yeah, we're gonna have to do that 2441 to get the child tax credit. Sorry. No, you're fine. Just take a lot sometimes to look at stuff. So if I'm on that back page, I've got to calculate the child tax credit. And I think there's one other thing. You can also look in the right column of your manual recap.
The dependent care credit.
Oh, okay, yes, social support section. Yeah, right, the dependent care credit, or no, that is the 2441. But they also get the child tax credit.
For the two that are under 17.
Right. I think also you have to do your A, don't you? Your Schedule A? Okay. So, let's just spend the rest of the time getting your forms printed, getting them in order. Really, as far as the source documents go, the only thing I'm going to spend time on, because you've seen a lot of these now, you're starting, let's see, is this the first page? Yeah. You're starting on this guy, right? The Charles Schwab. And, yeah, I'm not going to go through these. You should know now how to read a 1099. And again, I go through each of these with a highlighter. What kind of form is this? What data do I need? So we've got 1, 2, 3 pages of Charles Schwab. Then we've got a page of whatever this is, First Bank. Then we've got our first closing statement. Which house is this?
The one they got.
Yeah, this looks like, and you always, and again, if you have a highlighter or another one, you always look at that place's settlement address, and that can give you a hint to what you're talking about. So this was the house in Sugarland, Texas. And the settlement date is not 2009, it's the year we're in, 2017. And if you look up there on this very first little row, it says summary of borrower's transaction and summary of seller's transaction. And this is what a lot of buy-sells look like. Now, when you close on a piece of property, you get a book this thick full of stuff. And clients will bring you that book like, here, I do not need 182 pages. The first 2 pages are uniform, and they're They look pretty much like this. That's all I need. So the first thing I have to figure out is which am I in this transaction, like the borrower or the seller? I'm the borrower, because I'm buying a house. So nothing on the seller side matters to me. So line 103, this was, remember I was talking about a couple weeks ago or last week about closing costs and how that can be really a significant burden that you maybe don't think about when you're going to buy your first property. $4,311. And I said, and I'm helping you interpret this, recognizing this is the first time you're looking at this. Useful numbers include interest and taxes in that number. So you can't just take that whole 4312, you need to go look at what's in it. But I'm telling you, the useful numbers for you are going to be, is there a portion of mortgage interest in there? And is there a portion of property taxes? And I've already done the work and said, you know what, those numbers are on the 1098. What am I telling you?
Should go to the Form 1098.
Right, you're not going to replicate this 4312. It's on Form 1098. And let's just see if we can find that. Okay, here, 3 pages later, let's just take a look at the 1098 together. What am I looking at here and what am I going to take?
The taxes and the interest.
Yeah, taxes paid year to date and interest paid year to date. So in those numbers, those big numbers, the 64 and the 22, a portion of that was pulled out and is part of the settlement charges. But again, honestly, you've got to call sometimes the title company and figure that all out. I've done that for you because that's just what I did. How much did they pay out their principal this year? $8,661. And what's that HAS FLDINS number? That's your insurance. Do you get to take that on your personal home? Only if you have what? The only time you get a portion of your interest or insurance is if you, sorry? If you have an office and home. Or if I rent out my basement or whatever, okay? And then what's that T&I balance of $128? Remember PITI?
Is that taxes?
That's your escrow balance for taxes and insurance. Remember that escrow account you pay into every month? And then they disperse your property taxes, they disperse your homeowner's insurance? Do you do anything with that? Do I care what's in my escrow account?
That's no problem.
Well, I mean, I care because I want to make sure that it's accurate, but it doesn't do anything on my taxes. Okay, and I think that's really what you need to know about this. So let's go back and look at those last 2 pages of closing statements. So we looked at the first page and I told you that what happens with that 4311. Okay, now I'm just going to give you a second and I want you to look at this one and tell me what you think you're looking at. Yeah, this time, which house is it? Is that the rental or is that their personal home?
That is their
I don't know how I know that. How do I know that?
rental. Because 3495, oh, wait. Did you do
Okay, you guys have to figure this out. I think I must have put some text in the narrative that helps you determine that.
names on it, 3495 Circle 14 in Arizona was their old home, but you have 3495 Saguaro Street on this form.
Oh, okay. Thank you. So the address of their old home was 3495 Salvato.
So change the.
Yeah. So, sorry, I didn't make that congruent. I was asking you to match data to figure out what was what, but then I didn't do it. I didn't do that, so that would be very confusing. Okay. So take a look at that, and now I'm the seller, right? What do you think? Gosh, these are tiny little numbers. Is relevant here, and then there's a second page to it. So first off, let's just kind of look at this for data. How much did I sell my personal home for? $223,200, right? How much were my closing costs on selling my house? Holy crap, I paid $18,323 to sell my house. What do you suppose the majority of that's going to be? It's going to be commission you paid your realtor. I mean, I don't know that until I look at the second page where the detail is, but that's a big number for a $220,000 house. Okay, let's see, going down this, what else is important? They paid off, when I sell my house, obviously they have to pay off my first mortgage. So I still owed $157 on that. How much did I walk away with a check for from the sale of this property? Yeah, $46,535. In other words, my house has obviously gone up a lot in value, or I've been paying on it for a really long time. So my mortgage was $157, it was worth $223, and I picked up a chunk of settlement costs. Still walked away with 45 grand, right? Get a money order made out to you. It's pretty heady, even if it's not much. Okay, so now we're on the second page. If possible, these numbers look even tinier. And the first thing I want you to do is tell me what you think you're looking at, and then see if you can find a number that ties into the first page. Yeah, exactly. And again, this is all just sort of like playing detective. It's like unraveling a puzzle. All the way on the bottom of that right-hand column is that number, 18,322, whatever that was. So obviously all those numbers above it tally to that. So now your challenge is, what, if any, of these items go anywhere on the tax return? I'm the seller of my personal residence. How about the loan origination fee? Wait, where are they? These numbers are really so tiny I literally can't read them. Commission paid, $13,000. Sale of my personal home, does that go anywhere? Nope, that's just a personal expense. Gotta suck that up. Loan origination fee of $1,007. I don't know why I'm doing a loan origination fee. Why am I doing? You know what happened here? Because I'm selling the house. Why am I paying a loan origination fee? Sometimes those are things you can negotiate. Like you're like, I really want your house, but I have a couple grand shy, and I'm like, I'll pick up your loan origination fee. Put that over on my side. So that's what I did. Appraisal fee, credit report, all these things, really, all you're going to be looking for is you've got $420 of interest. Hopefully that's going to be in your 1098. I think I tell you it is. I don't think you need anything from here. That middle section, your hazard insurance and your county property taxes, that's all goes into escrow. That's not deductible. Some of these, okay, now we're down here. This guy, and you have no way of knowing this. I'm just pointing this out because we're learning this. And I'm going to give you a printout. I've got to go make copies that'll help you look at this. But so things like your settlement fees, your doc prep, your title insurance, all that, would impact this, but it doesn't matter at all sale of a personal residence because there is no gain or loss. Right, so if I sell my personal home and I have a gain of less than $500,000 if I'm married, you don't pay any tax on it. So all this stuff, I mean, matters if you've got a couple $1 million house, or it matters if it's a rental. It doesn't really matter on the sale of a personal. So we're just learning how to read this, but it's not relevant to numbers you're taking. Then you've got your 1098, and then you've got your second 1098. And that one, again, I've done a lot of the work for you. I penciled in, this is the house in Phoenix. What am I pulling from there? Yeah, taxes and interest, taxes and interest. This one doesn't show insurance. And that's it.